Let's discuss the accounting treatment of impairment losses. Impairment losses is to be discussed by accounting standard number 36. First of all, let me tell you the definition of impairment loss. If the carrying amount of an asset is exceeding its recoverable amount, then this difference is called the impairment loss. For example, the carrying amount or the book value of the asset is 50,000 and the recoverable amount is 40,000. So as the economic benefits are only 40,000 and we have recorded it at 50,000, so this is to be said that the asset has been overstated by 10,000 and this overstatement is called impairment loss. Or we can say that as per the definition, the carrying amount is greater than the recoverable amount by 10,000. So this 10,000 is called impairment loss. But remember, if the carrying amount is less than the recoverable amount is greater than the carrying amount, then there is no impairment loss. Now, another thing is that how we can identify that some asset has been impaired. For that, we perform impairment testing. Impairment testing means we compare carrying amount with recoverable amount. So let's identify what is a recoverable amount first. The recoverable amount is the higher value of the value in use of an asset, and its fair value less cost to sale. For example, if value in use is 10,000 and fair value less cost to sell is 11,000, so the recoverable amount is the greater of these two values, that is 11,000. Now, how we can identify value in use? Value in use is present value of future cash flows related to that assets. That means that if we use that asset in future, then the future economic benefits we can obtain from the use of that asset is called the value in use. We have to discount these cash flows. So we have to discount these cash flows at a suitable discount rate. And for that purpose, we need a cost of capital. So we find out the discounted value, that is the present value. Or if you think that we can sell that asset, then we can identify the fair value less cost to sell, another component of recoverable amount. In order to perform impairment testing, Some assets are required to be tested compulsory at each reporting date. And some are based on some indicators. And there are two types of indicators. One is internal indicators of impairment, another is external indicators of impairment. Those assets that require compulsory impairment testing at each reporting date are goodwill, subject to impairment, and those intangibles having infinite useful life, plus those intangibles that are not yet available for use. Means they are in balance sheet, they have been capitalized, but they are not subject to usage, so their value is constant. As far as internal and external indicators are concerned, one of the example of internal indicators is the physical damage of the asset. For example, if an asset has been physically damaged, or there's any destruction or some sort of damage to that asset, then there are chances of impairment of that asset. So what we have to do, that we will perform an impairment test, that is, compare carrying amount with the recoverable amount. And if carrying amount is greater than the recoverable amount, then there is an impairment loss. As far as the external indicators are concerned, there are various external indicators. One of the indicator to be classified as external is fall in market price of asset. Or we can say that any negative changes in economy, market, law, and technology. This might create some sort of damage to the value of the asset. So we need to perform an impairment testing, that is, to compare carrying amount with the recoverable amount. Now, the accounting treatment of revaluation, sorry, impairment loss. If as a result of impairment testing an impairment loss arises, then we have to recognize this loss immediately in profit and loss account. But if there is revaluation surplus brought forward available related to that asset, then in that case charge impairment against revaluation surplus. And if there is excess impairment loss, it can be charged in profit and loss account.